Hi everyone. Today I'm going to show you how to build a basic financial statement using Excel. Some of the very um, conventional financial reports that you see in a typical financial statement package would be your income statement, your balance sheet, your statement of cash flow, and also your statement of shareholders' equity. In today's video, I'm going to only show you how to prepare an income statement and a balance sheet. But before we do that, we have to build some supporting schedules that will help flow the money to these two reports. One of the schedules would be called a journal entry or a general ledger, but I'll just call it journal entries. This is the place where you put all the periodic activities for what has happened during the month. And the periodic activities depends on how often you want to report the information. You can report your information monthly, in every 28 days, every quarter, semi-annually. So it's really up to the business behavior of the business that you are reporting information about. So in this example, I'm just going to assume that we are reporting information in a monthly period. And the journal entry is basically your one-stop shop where you post all your monthly activities. And then your journal entries, the monthly activities, will flow to this separate support called a trial balance. And a trial balance is basically the balances of your debits and your credits. So the journal entries is like breakdown by line transaction, whereas the trial balance accumulates that to show you the total, such as the beginning balance plus all the individual monthly activities equals the ending balance. It'll make more sense once I get this going for you. And these two supports is what we're going to use to prepare the income statement and the balance sheet. So I'm just going to put some numbers in, and I'm just going to make up some scenarios. Let's just assume that it is January 1st of 2023. So we are reporting for the month of January 2023. And we're going to be completing a few transactions that starts the incorporation of this company. I'll just put 31st because it's as of month end reporting, because you're reporting everything in January as of the whole month end. So let's, for example, say for journal entry number 1, the company has incorporated. Company A incorporated, where shareholders bought 100 shares in exchange for an initial capital of $100,000. So For this entry, you always have, it's a double entries, double ledger entry. So that just means you have a debit and a credit. In this situation, they started a company and the shareholders, they purchased 100 shares to become shareholders in exchange for contributing $100,000 to start this company. And obviously, when this company, when you start it and the shareholders give you that $100,000, that money has to sit somewhere, right? And let's assume that they open a bank account to store this, deposit this money, because you don't just want to put it in a drawer. That would not make sense. So let's just assume that they opened up a cash checking account to deposit that $100,000. So for simplicity reasons, I'll put a debit of $100,000 to deposit this money. And then in exchange, these shareholders now have equity in the company. So that is a credit of $100,000. Oh, let's also say that the shares sell, well, if we're assuming that the shares are, they bought 100,000 of shares. Sorry guys, I'm trying to get the math right. And divided by 100 shares. So the shares are worth $1,000. $1,000 per share. So then you can do equals 100 shares times worth $1,000 a share. So then you have the equivalent of 100,000 in common stock. And next, let's just say that this is a very basic company and they sell cleaning services. And we're not going to make things too complicated. We'll just keep it simple. And let's say for journal entry 1, they bought some, company A bought some cleaning supplies worth $5,000. And these are long-term asset supplies because they'll last for a very long time, more than 30 days. So then with that being said, because it's a long-term asset, we can put it as a cleaning supply, and it'll be on the assets bucket of the balance sheet, but then it'll be long-term. So for our debit, we'll have $5,000 and they bought it with cash. So we'll just do a credit cash. Or actually, let me just put it here. And one thing I forgot to do is that while we are putting in a journal entries, it's probably a good idea that I put some account numbers for these account description items, because the account numbers will come from your chart of accounts, and this will help us organize all the these buckets. So let's just assume that the cash account is account number 1000, and then common stocks, let's just assume it's 80000, and then for cleaning supplies we'll do 100001, and then cash is just it's 1000. All right, so let me also make this red so it's easier to read the descriptions. Let's just say that they had their first business service provided to some customers, and they have made $500. So first cleaning service provided, and so in this case, and let's say they got the cash up front just to keep it simple. So they got $500 of reimbursement for the services they provided. And I'll just call it cleaning revenue. And then for this, I'll just call it 50000. So even though they provided some cleaning service, they used expenses to provide this revenue. So we'll also have to recognize some of the expenses that are associated. And let's say even though they made $500 providing the service, the cost to provide the service was $30. So then we'll put in some I'll just call it cleaning expenses for $30. And because they are using the cleaning of expenses because they have cleaning supplies and it costs them $30 to provide some of it, we'll have to depreciate a little bit of this asset here, because this cleaning supply that they use, it'll eventually deteriorate and depreciate in value, so it won't always be worth $5,000. But because now that they've used it, we'll just assume it'll lessen its value by $30. So then I'll have to do a credit of the asset there. And I'll call this 60000. And this will be journal entry number 3. So this should be journal entry number 2 up here. And it is coming towards the mid-month now, and aside from the revenues and the expenses for the operation of this company, there are also other general and administrative expenses. For example, there's electricity, and there's wages, and there's different kinds of utilities and fees to uphold the operations of the cleaning business. And I will just lump these up as general and administrative expenses. And they got billed to pay these expenses, these bills, and it's not due right away yet, but they know that they have to pay it soon. And usually invoices, it's due within a month. So let's just assume that it's due by the end of next month. That means they have to recognize those expenses for this period, but they don't have to pay it right away yet because it isn't due until February. So let's recognize that. So then I'll just expense something called a G&A expense, or the general and administrative expenses for the general upkeep of this company. And I'll just call it 6,000 and 60001, because they don't have to pay it right away yet. They can accrue it. So I'll call these accrued expenses since they don't have to pay it yet. And I will put this as a 20000. And the total bills that they got was $100. Let's assume. Oh, yeah. Let's just say that the shareholders and the directors and officers of this cleaning company has been quite creative. They are very investment savvy individuals, and they don't want to keep all this money in a cash account because it's not earning any interest, right? So as a result, they wanted to put some of the money to a surplus account so that it could make some money for them. And let's just say they're very conservative in their investment philosophy. So they're going to put some of this money into, let's say they put $50,000 into a money market account with Wells Fargo. Okay, so because of that, they opened up a new investment account. I'll just call it 11000, and let's just call it money market. And because if they put $50,000 into the money market account, this means that 50,000 will leave the cash account because they did this transfer. And this pretty much wraps up the month. So now that we have the journal entries, you can see it's like a general journal with all your journal postings, and I had forgotten to put the journal entry numbers. But if you were doing this in a computer system, it would definitely be a lot faster. But I just wanted to show you guys how to do it by hand. So 5 activities happened this month. Now, it's time to put it into the trial balance, which basically takes all these line by line double entries and total it up. Basically, the total balance of the debits and the total balance of the credits according to the account. So to build that, I will be using some formulas. And let's just call this a trial balance as of January 31st, 2023. We have the beginning balance, and then I'll show the interim, which is all these activities here. These are all the interim activities. and then you have the ending balance. And we'll have to organize these chart of accounts here to make it easier to organize. So if you notice off the bat, in accounting, we always have this fundamental equation where assets equals your liabilities plus shareholders' equity. So what this means, and I'll just color it, color code it for you. Basically, all the stuff you have is funded either by you putting money in, such as the shareholders initially capitalizing the company, and also, or if it's funded by liabilities, such as money that doesn't belong to you. So as we go through each of these buckets, I will help you identify if they are an asset, a liability, or an equity. Cash is an asset because it's things that bring value to your company. And then common stocks is an equity. Cleaning supplies, these are assets because they bring value and revenue to the company. Same thing with the cash here, and I should probably make these the same. So same thing, cash. And then on top of that, you'll have the movements each month. You have your revenues and your expenses, which contributes to your equity. And if you need to know more about this, there's a lot of videos online that teaches you more about it. So cleaning, this is a revenue, and then this one is an expense. So basically anything that changes up your equity is your revenue and your expense. And cleaning supplies, asset, general admin is an expense. Accrued expenses is a liability because you have to pay someone back the bills, if you recall earlier. The money market is an asset, and then the cash is an asset. So now that we have all the assets, liabilities, equity, revenue, and expenses categorized, we can bring this to our trial balance. So I will organize it by account number and account description to do the formula. So we have our cash. We'll start with organizing it by assets. And we have the next asset is our cleaning supplies, but I'll actually put it here because I'll probably prefer put money market under cash for organizational purposes. And then now that we got the assets covered, I'm gonna put in the liabilities, which is just one for now. And then next I'll put my revenues and expenses. So we have beginning with the revenues, we have the cleaning revenue. And then for the expenses, we have cleaning expenses. And then we have our general and administrative expenses. Lastly is the common stock. So now that we have our chart of accounts organized better, then the beginning balance would be 0, because before this company incepted, there was nothing going on. But when you do February's, you're going to have the beginning balance, which was the ending balance of January. But before January started, there was nothing going on. So then the ending balance would be the beginning plus your interim changes. So then to document all the balances of our debits and credits, I'm going to do something called a sum if. So I'm gonna do, because I'm gonna look up these account numbers and give me the sum of the debits and the credits. Because we know that it's a double entry, debit minus credit equals 0. So if our formulas all get in here afterwards equal to 0, then we know that it's good. So I'll do sum if, and the range is here. The range, I'm looking it up through the account number, the range, and I'll lock it up by hitting F4, or actually it's not working. So I'll just do $signs to lock it up, because usually when you hit F4, it'll lock it up for you, but it didn't work. And then our criteria is, we're looking it up by the account number, and the sum range is this, the debit side. And I'll also lock it up. And this is the first side of the lookup, which is the debit side. The credit side will be negative, because we want positive plus negative equals 0. So I'll do sum if range is here, and I will lock it up. Criteria, what I'm trying to look up is the account number, and then the sum range. So I want to total the credit side now. And close parentheses. And so now I will bring this down and total it, and it's a 0. So that means our debits and credits balance with each other. And so basically this is telling me the total balance of our debits and credits. And to test yourself, let's just say we can test it by checking out the cash. So for example, the cash had a beginning balance of $100,000, and then you spent $5,000, and then you made $500, but then you transfer $50,000 to another account. So the total balance is $45,500, which agrees. Actually, it doesn't agree. Let me double check. It should be $45,500, but I am getting something different. Oh, it's because the account number is wrong here. So this should fix it. So 45,500. All right, so that's a way to test it if you want to go by line, but by doing this, it summarizes it all up for you and telling you what is the balance at the end of the month. So then when you do February's financials, you'll grab this number as the beginning balance of February, and then the interim will be the February activities, and the ending will be the ending balance. So now that we have both of these core support schedules, we are ready to prepare our financial reports. So now I'm going to prepare a balance sheet. I'll just color code it. Okay, balance sheet as of January 31st, 2023. The balance sheet is basically the balances of your assets, your liabilities, and your equity. This is helpful because it tells investors or business owners and just any people who need these type of information what are the balances of everything, because if they want to look at what's the balance of the cash checking account and what are some of the balances of all the liabilities going on with this company, the balance sheet is a snapshot at a time and place of the balances of everything going on with this company. So as mentioned, it's organized as in assets, liabilities, and then your shareholders' equity. Now, me doing it as a shareholders' equity is assuming that it's a C Corp. So if it was an LLC, it'll be called something else. For example, membership interest for LLCs. So the asset side, we have all these. So I'm just going to copy it. And then for the liabilities, we have just one. And then for the equity, we have our common stock, but we also have our net income and retained earnings. And net income, this will come from the income statement. Retained earnings, it's not going to have anything for the first year because retained earnings is basically when you close out your income statement, you close out your net income numbers and put it to the retained earnings bucket. So as of January 31st, 2023. Don't know why I present it like that. I wanted to make it by, let's do it by this style. Short date here. So how come it's handy in preparing the balance sheet? Because now I'm just going to pull the numbers from the trial balance, which is the ending balance bucket, because I want the balances of everything, hence balance sheet. So we have our cash, and technically I could use a VLOOKUP for that too, so I'll do that just to save time. So then it'll update automatically each month for you. Three. So you can VLOOKUP it like that. Okay. And these two won't pull from the trial balance because these pull from the income statement. So I will leave these two out by deleting the formula. And because these are credits, it's showing as a negative balance, but you can always put a negative to the formula to make it positive. Okay, so we'll also do a total subtotal for each. Total assets, total liabilities, and then your total shareholders equity. We'll do it as with a double bottom line. Let's do it like that. So then this will sum up your total assets. Bold it. Sum up your total liabilities, which is just this one, and then your total equity. Now, this won't equal yet because if I do a check, the accounting equation is assets equals liabilities plus shareholders equity. It's not going to equal yet because we also have to factor in the income statement activity. So you can see I'm off by $370, but that's because I still have to prepare my income statement to fill in these two buckets. Now, moving on to the income statement. Now, you ask, what is an income statement? The income statement is really just a performance, monthly performance. Whereas the balance sheet is the balance of all the components that make up a company. The income statement is saying, how is this company doing? Is it profiting? Is it at a loss? Like, what's going on? What are my biggest profits here? What are my biggest expenses? It provides really insightful information to see what's the financial health of the company. How is the income going on? Is there even any income? So yeah, so let's just call it income statement as of January 31st, 2023. And I'm just gonna borrow this here so I don't have to type it up again. So we will start with the revenue, the things that are producing money and income for the company. And as we have previously discussed, from the journal entries, there's revenue and expenses. So these will help measure the revenue profitability of a company. So we have one revenue contributing revenue bucket here. So we have our cleaning revenue. So the company is making most of its money with cleaning revenue. And then I'll do a subtotal for total revenue. And then expenses, we have two types of expenses, a cleaning expense and a general and administrative expense. Now you can really like sub categorize it even further, but for simplicity purposes, I'm just gonna lump it up. And then we have earnings before tax or you can say, or you can actually call it net profit or loss, net profit or loss before tax. This is kind of like your EBIT. So for our revenue, we have, and you could use VLOOKUP for this too, but since it's so small, I'll just use, I'll just like reference it from the trial balance. So now you see how helpful the trial balance is, because it basically helps spits out the numbers to your balance sheet and your income statement. And even though the cleaning revenue, it says is a negative, it's a positive revenue. And the reason, because revenues are credits, so that's why you put it on a credit side. That's why it's a negative. And expenses are debits, and it's a positive number. So then for our expenses, we have our cleaning expense, and they are interim activities. So it's basically telling you what's the financial earnings activity of the month. So actually I should be pulling it from the interim. The balance would be the year to date, but since it's only been 1 month so far, it's gonna be the same total. So I should actually go back here to the trial balance and choose this one here, the interim. Because once you're year to date, once you have February, March, April, etc., you add up all the individual interims to give you the year to date balance. And let's fold this, and let's do a double bottom line. So our net profit is $370. So now I haven't factored in the taxation, but you could do that. And to do that, we can just add an additional line for tax. And you can put it here as a FIT expense, federal income tax expense. And there's no deferrals and other things like that. Let's just assume for simplicity purposes, as a C Corp, it's straight 21%. So now you will have your net income here. Now, because we also factor in taxation, we have to recognize this tax expense as in our journal entries. So I'm going to go back to my journal entries here and add another journal called JE number 6 and recognize the taxes here. This is tax due, so it's an expense. So I'll just put 60002 for tax expense. And then because you don't pay taxes until when it's due, it's gonna be accrued as a payable. So I'm just going to name it federal income tax payable, because you're not, remember, like with IRS and everything, you don't pay it right away unless the corporation elects to pay quarterly withholdings. But let's just assume this company, it's not due yet, so it's a liability. So let's name it 2001. And because we added new entries, we'll have to update our trial balance, and I will show you shortly how to do that quickly. And we have discussed that it was a tax of $77.70. So let's go back here and do $77.70. And because now we need to add it to our trial balance, I'll go back to trial balance and add a new line under liabilities and just paste this in. And then we also have a new expense now. So same thing, copy and paste it. And then it starts out with 0 balance, but now I have to update my formula basically now to cover these extra 2 lines, because before my formula stops at B26, which is right this line, but now it will go down to 3 more lines to B29. So I'm going to update the first formula to B29 for all the ending lookups. And then I'm just gonna drag this down, and this will update the formula for me. And I also have to update the ending balances now because it has changed, because we factor in the taxation. So because of that, we now have a new liability, which is the federal income tax payable, because they have to pay these taxes due, but since they're not paying it right away, it's a payable. And then at the same time, yeah, so now that I updated this formula, it should pull through here, and I'll have to update the sum because now it increased the liabilities. So now we know that our net income is $292.30, and as you recall, net income statement is the periodic activities, but the balance sheet is the balance of everything. Your net income is a component of your equity balance. So that's why I have to pull that number from the income statement. So now our cross-check would be 0. And so then, like, once the year keeps happening towards the end of the year in December, your year-to-date income statement balance as of year-to-date will update. And then when you close the books for the year, you're closing the year of 2023, all the net income balances will move to your retained earnings. You're closing out your revenues and your expenses. So closing it out of the income statement and putting it in the retained earnings bucket. So then when you start 2024, you don't have a balance here. And then the net income will start capturing the fresh new numbers for 2024, but you'll always have a retained earnings balance after you close out the first year. So basically, retained earnings is like the net income, accumulated net income balances of all the years, whereas net income is the year to date, what's going on this year. And this is very important for investors or like whoever reads these reports, because it's telling you, well, how are we doing this year? If this was a negative, it's saying that the company is not operating at a profit. And then shareholders or directors, board of directors, whatever, management, they'll have to make some decisions. So that's why there's that segregation between your net income and your retained earnings. Retained earnings is like how much has been retained since the beginning, all the net incomes that has accumulated. Do we have enough money to make a shareholder distribution? So these are all kinds of questions that will come up. That is why the balance sheet and the income statement are so helpful, because at a glance, the management can be like, oh my God, liabilities are so high. What can we do to bring it down? Or, hey, why do we have everything sitting on a cash account? Let's put it in some bonds. Like the bond market is doing pretty well. And then the income statement is like what's going on each month. Well, this month, let's just say that for this month, our profit margin is saying that is 58%. Profit margin is 58%. So for every dollar of revenue made, 58 cents actually goes back to net income. So there's different things that, the professionals or like decision makers use to make decisions of what's going on with the company. And that is why it's so important that we know how to prepare these. And it starts very simple from what's going on every day for the month of this company. And now we put it into the balance of everything. And then we present it in an organized, balanced manner, but also telling you what's going on each month. And the year to date for now is just going to be the balances of January for now, since it's only the first month start. Yeah, so hopefully you find this helpful, and this is such a watered down, dumbed down version of how to do it, but I think by showing you the basics, it'll make more sense. Thank you so much for watching. I hope you enjoyed this video. Take care and let me know what your thoughts are on the comments below. Thank you.